Tonight's London Open is more than just another fix. It's the moment when the numbers stop lying and the market's invisible pressures become painfully real. After the staggering withdrawal of 12.7 million ounces from London vaults last week, a 1.08 billion physical silver drain, the market is tightening to a degree not seen in decades. The East continues to signal its intent. The Shanghai premium over London has surged again, now 21.3%, reflecting a staggering divergence between Eastern and Western silver markets. This gap is no longer a minor arbitrage opportunity. It is a warning light flashing red. For context, when the Shanghai premium was negligible, physical silver flowed freely across borders. Today, it's being hoarded, withdrawn, and locked into Eastern vaults. The message is clear: the West is running short, and the East is quietly controlling the supply. While physical silver vanishes from London, COMEX shows 142 million ounces of open interest, but only 31.2 million ounces are actually registered for delivery. That's a 4.5x paper-to-physical ratio, unsustainable if even a fraction of contracts are exercised. Traders should understand this. When paper contracts vastly exceed physical availability, any sudden demand for delivery can trigger a market shock. The market may appear calm, but under the surface, it's a pressure cooker ready to explode. The divide between paper silver and physical silver is now critical. Paper contracts give the illusion of supply, but real-world metal is shrinking. Dealers report withdrawals, not sales. Physical silver is being stacked or shipped east, while Western inventories dwindle. This is exactly the kind of imbalance that has historically preceded sudden price surges. Analysts who ignore this may be caught flat-footed when the London Open reacts. The LBMA fixing banks control the official silver price. But when 12.7 million ounces vanish from vaults, it becomes impossible to maintain the illusion of abundant supply. Banks may try to smooth price moves during the fix, but the underlying physical shortage cannot be hidden indefinitely. Investors watching this must ask, if the numbers don't lie, then what hidden pressure points will emerge tonight? Technical levels. Traders must watch 1. $25 lower per ounce. Psychological resistance may trigger short-term panic if broken. 2. $26.50 per ounce. Key technical level representing the last week's peak physical demand. 3. $28 per ounce. Breakout point if physical withdrawals continue. Could spark volatility across COMEX and London. Even casual observers should note these levels are not guesses. They are derived from the actual flow of metal, premiums, and open interest. Dealers report frantic calls from buyers seeking physical silver. Many contracts are being canceled, rolled forward, or partially fulfilled. The takeaway is simple. Physical silver is scarce and demand is growing. One dealer told analysts, "It's not about the price right now, it's about availability. If you want silver, you need to secure it before it disappears." What this means for stackers and traders, stackers, long-term holders, now is the time to secure metal. The supply gap could widen before any official price spike. Active traders, volatility is guaranteed. Expect sharp swings around key technical levels. Short positions are risky when the market is tight physically. Bullish versus bearish. Scenario's bullish case, continued withdrawals from London vaults. Rising Shanghai premium indicates persistent Eastern demand. COMEX paper contracts vastly exceed physical backing. Any delivery demand could explode prices. Bearish case, limited. LBMA and central banks may intervene to smooth the fix. Paper market might temporarily suppress visible volatility. Some short-term profit-taking may occur after the initial spike. Even so, the fundamental physical pressure remains. Any intervention is likely temporary. 5-point action plan for tonight: 1. Watch London Open. Live updates, real-time withdrawals matter more than price chatter. 2. Track Shanghai premium. Rising premium signal continued physical pressure. 3. Observe COMEX delivery notices. They show potential squeeze points. 4. Secure physical silver if stacking. Availability is critical. 5. Be prepared for volatility spikes. Both stackers and traders must respect the physical market reality. Final thoughts tonight. London confronts the impossible math of silver markets. 12.7 million ounces gone from vaults. Shanghai premium climbing. Paper contracts exceeding physical metal by multiples. The story is unfolding in real time, and ignoring it is not an option for anyone involved in precious metals. Stay informed. Watch carefully. Understand the real supply-demand pressure. Tonight, the London Open may define silver for months to come. 5-point strategy for stackers and traders. 1. Monitor London vault withdrawals in real time. Physical flows matter more than paper prices. 2. Track Shanghai premium. Rising numbers signal continued scarcity. 3. Observe COMEX delivery notices. These reveal potential squeeze points. 4. Secure physical silver now. Stackers must act before supply disappears. 5. Prepare for volatility spikes. Traders should respect the physical reality behind paper contracts. Global implications. The silver squeeze is no longer a local anomaly. It signals a systemic shift in global precious metals. Eastern nations are consolidating control over physical silver, giving them leverage over pricing. Western markets remain heavily paper-driven, with physical shortages threatening sudden spikes. Traders, stackers, and investors must reevaluate risk and strategy, as the next months may define market direction for 2026 and beyond. Conclusion: the London Open aftermath. The first London Open set the stage. The withdrawals, Shanghai premiums, and COMEX imbalances have confirmed that physical silver is in short supply. This is not speculation. It's real, measurable, and unfolding in front of the market's eyes. For stackers, act decisively to secure metal. For traders, respect volatility and key technical levels. The global silver market is entering uncharted territory, and those who understand the data will have the advantage. The London Open was just the beginning. The story continues, and the next moves could be historic. The dust has barely settled from tonight's London Open, and yet the reverberations are already shaking the global silver market. The numbers that emerged are staggering, yet they confirm what informed traders and stackers had feared. Physical silver is tightening at a rate that cannot be ignored. In the week following the London Open, another 8.5 million ounces of silver have disappeared from London vaults. That's roughly $725 million worth of physical metal physically withdrawn, not rolled forward or traded. The cumulative withdrawals now total over 21 million ounces in just 2 weeks, representing a financial mass exodus of silver that is unprecedented in modern market history. Dealers report frantic buyers attempting to secure metal in small parcels, with premiums rising accordingly. The East continues to hoard, while Western inventories shrink, signaling an East-West supply imbalance that will have implications for months. After the London Open, the Shanghai premium over London jumped to 22.5%, setting a new all-time high in recent years. For traders watching the arbitrage, this is no minor anomaly. It has a strong signal that Eastern demand is crushing available supply. This premium is essentially a price difference between East and West that reflects the scarcity of deliverable silver. Every increase shows that buyers in Asia are willing to pay substantially more for immediate physical delivery, a trend that cannot continue without affecting the global market. While physical withdrawals accelerate, COMEX still shows 142 million ounces in open interest, with only 31.2 million ounces backed for delivery. This 4.5x paper-to-physical ratio remains a ticking time bomb. Analysts warn, if even a fraction of these paper contracts demand physical settlement, the market could face instantaneous volatility, pushing prices sharply higher. Traders betting on stability may find themselves blindsided. The London Open set off a chain reaction across technical price points, $25.50 per ounce. breached psychological resistance, triggering stop-loss cascades. $27 RRs per ounce, retested multiple times as new physical withdrawals occurred. $28.50 per ounce, emerging as a breakout target if physical scarcity continues. Investors watching these levels closely know that any breakout may spark a rapid spike across both paper and physical markets. Physical silver dealers confirm that shortages are tangible, not theoretical. Calls from buyers are more frantic than ever, with some reporting partial deliveries only and others being forced to pay elevated premiums to secure metal. One dealer stated, "Paper prices might fluctuate, but the reality is physical availability. If you don't act now, you risk missing your allocation entirely." This is a direct warning to both stackers and traders. Supply is finite and disappearing fast. Bullish scenario. Silver breakout. Persistent withdrawals in London vaults continue. Shanghai premium keeps climbing. COMEX open interest remains unbacked. Technical breakout above $28.50 per ounce triggers a cascade of margin calls and panic buying. If all these conditions converge, we could see a historic silver price spike reminiscent of the 1980 Hunt Brothers squeeze, albeit in a modern, globalized market. Bearish scenario. Temporary suppression. LBMA and central banks could temporarily intervene to smooth the London fix. Some Western buyers may pause, hoping for lower premiums. Short-term profit-taking might temporarily stabilize the price. Even in this scenario, the physical shortage remains real. Suppression is likely temporary, and the next London Open could reopen the pressure entirely.